Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about silver, gold, precious metals, economics and politics. Today is Saturday, the 2nd of February 2019, and we are commenting on an article written by Russell Napier in the banking journal Financial World, February-March 2019 edition. The article is entitled The Great Wall of Money. Now, Russell Napier is an independent strategist and co-founder of the investment research platform Electronic Research Interchange. In this article, he warns of dire consequences for the global economy when China moves to a flexible exchange rate, which he says is likely to happen soon. We're now going to read the article, which is about 5 minutes long, and then make a comment on it. Quote, China's policy of mercantilism via exchange rate intervention will end, and maybe soon. It is difficult to base prosperity on external surpluses when your economy is so big. It is also politically difficult to accept the periods of deflation such a policy almost guarantees when your exchange rate becomes overvalued, as it will become in China, and probably now is. When China moves to a flexible exchange rate, it will turn everything you think you know about investment on its head. You can expect a decline in the renminbi to trigger global disinflation or deflation, and perhaps debt default by China's biggest competitors. Faith in the ability of the other central banks, even the Federal Reserve, to generate inflation under these conditions would be severely shaken, with negative impacts for global equity prices. But the impacts will go further. A flexible renminbi means a new asset class. Currently, managers of foreign reserves can hold US dollar balances, knowing this is tantamount to holding renminbi, given the composition of the basket against which the renminbi itself is managed. When the renminbi floats, a switch to renminbi will be necessary, which involves selling something, and that something is almost certainly US treasuries. That either means higher US bond yields or higher US savings, neither of which is good for US growth or global growth. Once China has an independent monetary policy, private investors will probably face a decline in the correlation between Chinese and non-Chinese asset prices, virtually compelling them rapidly to boost their weightings of Chinese equities and bonds. Some claim this will happen only if China has a stronger rule of law to protect portfolio investors, and Chinese bonds and equities are attractively valued. But given the index-driven nature of modern investment, such sound reasons for caution may not stem the tide. Again, such purchases would have to be funded from the liquidation of other assets or much higher global savings, neither of which is likely to boost those portfolio assets or economic growth. Investors should also expect China to inflate away its debts. Indeed, given its central role as an exporter, China's policy will likely to be the marginal detriment of global inflation. High Chinese inflation will cause havoc for developed world nations where independent central banks are tasked with keeping inflation at 2%. If the world's second largest economy chooses to engineer possibly double-digit annual inflation to reduce its debt burden, what nominal interest rates would the West need? Whatever central bankers decide, bond investors will demand very high nominal interest rates. Interest rates at the level needed will probably challenge financial stability and social cohesion. History suggests that the central policy response in developed markets would be a period of prolonged financial repression in which nominal interest rates are kept low while inflation is allowed to rise to lower government debt. There could be no larger challenge for investors than to see the 1980 to 2018 investment environment replaced with a severe repression in which investors operated from 1939 to 1980, particularly those in Europe. The key to the success of administrative measures in rigging prices is in imposing a barrier to arbitrage in the form of capital controls. Everything you think you have learned about investment in the past 30 years will mean nothing should the move to a flexible renminbi trigger such aggressive financial repression. The above is the briefest outline of why one simple and inevitable change, the move by China to monetary independence, changes everything in economics, finance, and markets. The most important impacts will be in other areas. A role for Chinese assets within foreign reserve and investment portfolios has negative consequences for the US in particular. Would the US administration permit a flow of capital primarily into a bond market funding the activities of the Communist Party of China? If these capital flows to China were stopped by US action, how far would the renminbi have to fall? Which countries would hitch their economic wagon to China when the loss of US military protection would ensue? One decision on the Chinese exchange rate will likely help shape the future of this century." Unquote. What an interesting article, and this and many others are what bankers and central bankers debate on a continual basis. Back in June 2017, David Lipton, first Deputy Managing Director of the International Monetary Fund, said in a statement that China should gradually strengthen its monetary policy framework, allowing the yuan to move more freely and improving communications with markets. Quote, "Capital flow measures should be applied transparently and consistently. Further capital account liberalization should be carefully sequenced with the necessary supporting reforms, including an effective monetary policy framework, sound financial system, and exchange rate flexibility." Unquote. However, other commentators have argued that due to China keeping their exchange rate pegged to the US dollar, China buys and invests a lot of money into US treasuries. Buying these US treasuries puts money into the American government, which keeps interest rates low. These low interest rates reflect on the United States housing market. In a nutshell, China buying US treasuries keeps American mortgage rates low and allows people to buy houses more easily. If China switches over to a floating exchange rate, the yuan will go up in value because it is currently suppressed due to government intervention, and cause a decrease in the value of the American dollar. Therefore, all the foreign reserves and treasuries China has in its possession will essentially be worthless, which will cause them to sell these reserves. We actually doubt this, as we can already see reserves are gradually being reduced now. Upon selling these reserves, the American dollar will move, necessitating a rise in interest rates, causing another crash in the housing market. However, Russell is arguing that massive deflation will occur worldwide if China moves to free and floating exchange rates, and the authorities will find it extremely difficult to inflate their economies. What do you think is right? Experts broadly disagree. If Russell is right, then the IMF encouraging China to float will do irreparable harm to the global economy. And yet, the IMF believes the opposite will occur. Our stance has always been to allow free and floating exchange rates, as this will show when economies are weak and when they are strong, and the currencies move and interact to serve as a correcting mechanism. That said, we also do not underestimate the considerable turbulence that can occur when a currency moves from a pegged situation to a free-floating one in the short term, especially when this unpegging occurs at the wrong time. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.